Welcome back to Business Incorporated here on Channels Television. Let's head straight to Eastern Africa, where the Kenyan shilling has, in one of the costliest free falls in history, lost its value, trading against the US dollar by nearly half in under 50 months. And that makes consumers pay dearly for imported goods. Several commercial banks are already selling US dollars above the 150 shillings mark in Nairobi, piling pressure on the Kenyan shilling while setting up consumers for a new wave of currency-driven price increases across imported products, including fertilizers, electronics, and cars. We have Matt Kindiga now joining us from London, practice leader, Sub-Saharan Africa, Front of View, to tell us what else he knows about what's going on, especially with Kenyans and their shilling. So, Matt, good afternoon. What's your forecast for the shilling over the coming months?
Hi, good afternoon. Thanks for having me on the show. So, our base case view is that the shilling remains overvalued at the official rate. Our view is therefore that the shilling will continue to lose value, and we are expecting it to exceed 150 per dollar at the official rate by the end of this year. And this means effectively that the central bank is going to continue to allow a steady depreciation of the currency. It's currently hovering at about 143 per dollar at the official rate. So we are going to see more depreciation, and this is really being driven by slumping sentiment towards the country around, weaker public finances, but also because we're seeing strength in the dollar. The US Federal Reserve, the Bank of England have raised interest rates recently. And although the Kenyan Central Bank has done so as well, we haven't seen them raise interest rates quite as quickly. Our view, however, is that in 2024, the pace of depreciation will slow, and we are expecting the shilling to stabilize somewhat at around about 150, maybe 155 per dollar. And this is because we are expecting the economy to improve a little bit, interest rates in the US to begin falling, and also because tourism revenues are probably going to pick up in Kenya next year. So a bit more depreciation followed by stabilization next year.
Well, a lot of African countries are expected to stabilize next year. I hope they can survive until then. But I mean, in this wave of imported goods, of course, costing much more than it used to, what's happening to businesses? Perhaps there are some businesses that deal with imported goods that are cashing in on this.
Yes, well, I mean, the biggest impact that, most of our multinational clients that we advise operating in Kenya, and also some local businesses, are saying is that this creates massive uncertainty for them because, 6 months ago, a year ago, they were budgeting for 120 per dollar, perhaps in a worst case scenario, or 130. But now we're facing a world where the shilling is going to be 150 per dollar very soon. This creates massive planning problems. It's also very inflationary, as you mentioned. Goods being imported into the country are rising in price, and this is squeezing margins quite significantly. And the problem is that this is being compounded by the fact that the country's economic growth is slowing. So you're facing rising costs and slowing economic growth and slowing demand. So a real bind for many companies. But also we are seeing forex shortages. So foreign currency shortages are a problem in Kenya. But the silver lining here is that as the currency depreciates, we are expecting forex shortages to get a little bit better. So there to be a little bit less pressure on foreign currency availability at the official rate, at least. So although it is quite a difficult environment as a result of higher costs because of the depreciation, it does mean that we're probably going to see fewer foreign currency shortages going forwards.
And what can we expect the central bank there to do?
So our view is that the central bank will certainly raise interest rates. It has been raising interest rates, not quite as quickly as other markets globally, but we are expecting more interest rate hikes. Our view is that if the central bank wants to allow the shilling to return to more of a free float, so at the moment it really is it's controlling the pace of depreciation very heavily through interventions into the forex market. If it wants to allow a free float, the interest rates in Kenya need to rise relatively substantially. So we are expecting to see more interest rate hikes come in Kenya, although we probably have to wait until social unrest in the country subsides first. There are also a couple of other things the central bank can do. It can provide commitment, or it can help or encourage the central government to ensure that it is committed to helping the country's public finances stabilize. So investors, if they want to become a bit more confident in Kenya and also make sure that the shilling is a bit more stable, we do need to see very firm commitments from the central government that they are looking to stabilize public finances, introduce painful but necessary austerity measures over the coming months. So certainly a few things that the authorities could do over the next few months to stabilize the shilling.
Yeah, unfortunately, this is the story of a lot of African countries at this time, the shortage of FX and the need to take some tight and harsh austerity decisions. But thank you so much, Matt Kindiga, for your perspective this afternoon, and do have a great weekend.
Thanks, you too.